A 60-year-old couple earning $85,000 is on track to see their annual marketplace premiums jump by more than $22,600 in 2026, according to KFF analysis of federal marketplace data. That is not a typo. It is what happens if Congress lets the enhanced ACA premium tax credits expire, and it hits far more than just that one couple. I read the fine print so you don't have to, and here's the plain version. The Inflation Reduction Act temporarily supercharged the ACA premium tax credits, so millions of people paid far less each month for marketplace coverage. But according to KFF, those enhanced credits are scheduled to end after plan year 2025, reverting to the original, weaker formula. And unless Congress acts, 2026 gets ugly. Here's the mechanism that trips people up. When enhanced premium tax credits disappear, you lose hundreds to thousands of dollars in federal help per year, according to KFF. So your net premium, the amount you actually hand over, explodes even if the plan's underlying sticker price only rises a little. It's the subsidy vanishing, not the insurance getting more expensive. That does most of the damage. This is not a niche problem. KFF estimates average annual premium payments for subsidized enrollees jump 114%, from $888 in 2025 to $1,904 in 2026, while a 45-year-old earning $25,000 sees a benchmark silver premium rise 573%. And in 12 healthcare.gov states, KFF says annual payments would at least double on average. This is general information, not personal advice, so check your own plan. Let that one number land. The average subsidized enrollee goes from paying $888 a year in 2025 to $1,904 a year in 2026, a 114% increase, according to KFF analysis of federal marketplace data. That's more than double for the exact same coverage. Here's the buried detail that makes 2026 worse than a simple subsidy story. According to KFF, 312 ACA marketplace insurers are proposing a median 18% premium increase for 2026, more than double last year. And the Urban Institute found benchmark silver premiums jumped 21.7% between 2025 and 2026, versus just 2% average annual growth from 2020 to 2025. So the subsidy cliff and a sharp sticker price hike are hitting at exactly the same time. Don't just let your plan auto-renew. That's how people get blindsided by the full increase. First, log into healthcare.gov and compare 2026 plans by estimated premium after tax credits, checking at least 3 alternatives, including a lower-cost bronze option. Second, run the CMS eligibility screener to see if your income qualifies you for cost-sharing reductions under 250% of the federal poverty level, or even Medicaid. This is general information, not personal advice, so confirm your own numbers before you switch anything. The clock matters here. If you let open enrollment pass and let your current plan auto-renew, you can get locked into coverage carrying the full increase. So the window to reshop and recheck your subsidy eligibility is exactly when to act, not after the bills arrive. Before I get to the last piece, which is the most important thing to watch, if this is useful, subscribe, because the next breakdown is already coming. What happens next rides entirely on Congress. Whether they extend the enhanced credits is a live decision. And KFF estimates that if they lapse, subsidized enrollees pay roughly $1,016 more per year on average than under an extension. Watch for any vote before open enrollment, because it changes the math for everyone on a marketplace plan. Next, I'm covering exactly how to model your own 10-year health cost projection, so you can decide whether staying on the marketplace still makes sense for you. If you want to catch that breakdown the moment it drops, subscribe so you don't miss it. I'll keep you across every congressional move on these credits, so your premium never blindsides you again.